In a market where we all have access to pretty much the same information, finding a real sustainable edge can feel, well, almost impossible. But what if that edge isn't about some secret data? What if it's about applying a much more disciplined, almost forensic framework to the information everyone else just skims over? Today, that's exactly what we're going to do. We're going to conduct a deep dive into Morningstar's guide to quality investing to forge that very edge, moving way beyond surface-level stuff to find out what really matters.
All right, here's how we're going to break this down. First, we'll talk about what an analytical edge even is. Then, we're going to put on our green eye shades for what I'm calling the cash flow inquisition. After that, we'll switch gears and run a moat sustainability test to check for real competitive strength. From there, we'll tackle the super important part, price and speculation. And finally, we'll pull it all together into one powerful framework you can actually use.
So let's start with a central question. In this ridiculously competitive market, where does an investor's true advantage really come from? It's not some hot stock tip, and it's not some super complex algorithm. The real edge comes from thinking differently, from applying a structured, skeptical, and frankly, a more rigorous mindset. To do this, we kind of need to develop a split personality. We have to adopt two very different expert mindsets. First, we have to think like a forensic accountant, a deep skeptic who doesn't trust anything but cold, hard cash. Second, we have to become a strategic moat hunter, someone who looks past today's numbers and sees the durable, long-term advantages that really protect a business. Mastering both of these is the absolute key. So let's start by putting on that forensic accountant hat.
Okay, let's get into it. Before we even start asking if a business is a good business, we have to ask a much more basic question. Are the profits we're looking at even real? This is the cash flow inquisition. It's all about following the money, because the money trail never lies.
This right here, this captures the entire spirit of forensic analysis. It's so simple, but so powerful. You see, accounting earnings or net income, they're really just an opinion. They can be managed, they can be massaged, they can be manipulated. But cash flow is a fact. It is so much harder to fake.
And this just perfectly illustrates the danger. I mean, look at this classic case of Lucent back in the late 90s. If you just looked at their net income, you'd think you were looking at a rocket ship. It soared by almost 700%. But if you looked at the actual cash coming in the door from their operations, it completely collapsed. It went from positive $2 billion to negative. This huge gap was a screaming red flag that the earnings were basically a fantasy.
So how is a disconnect like Lucent's even possible? Well, it all comes down to something called accrual accounting. It's a standard practice that lets companies record revenue the second a product is shipped, not when they actually get the cash in their bank account. This creates a natural gap between reported profit and actual cash, and it's in that gap where all sorts of shenanigans can hide.
So here's your toolkit. This is the forensic accountant's checklist. We already saw the number one red flag with Lucent, cash flow and net income going in opposite directions. Another big one to watch for is serial chargers. These are companies that always seem to have one-time expenses or write-downs. After a while, they're not really one-time, are they? A huge one is watching accounts receivable. That's the money customers owe the company. If that's growing way faster than sales, it might mean they're booking sales they can't actually collect on. And of course, if the chief financial officer or the company's auditor suddenly quits, that's always a massive warning sign.
Okay, so our forensic accountant has given the all clear. The numbers are real. Now, we switch hats. We become the strategic moat hunter. We verified the numbers, but now the question becomes, is this business just a flash in the pan, a temporary winner, or is it a true long-term compounding machine?
And the key idea here is the economic moat, a term that Warren Buffett made famous. It's a perfect analogy. Just like a moat full of water protected a medieval castle from invaders, a strong economic moat protects a company's profits from competitors. Because, in a free market, big profits are like a beacon, attracting rivals. A moat is what lets a company fight them off, year after year after year.
So, according to Morningstar's framework, companies can build these moats in 5 main ways. They can have a product that's just genuinely better, with better tech or features. They can have a powerful brand that people trust. They could have a lower cost structure, maybe from being bigger or just more efficient. They can create really high switching costs. Think about how annoying it is to change banks that basically lock customers in. Or they can build a network effect, where the service gets more valuable as more people use it.
Now, this is the really crucial insight. Not all of these moats are created equal. An investor's real strategic edge doesn't just come from finding a moat. It comes from understanding which of these advantages are kind of flimsy and which ones are built to last for decades.
So on the left, you've got moats based on having a better product. A company with some hot new tech. The problem? That just puts a giant target on your back. Competitors are working day and night to copy you or make something better. Technological leads can be super profitable, but they're often very short-lived. But on the right, now you have structurally, almost mathematically, superior moats. Things like high switching costs and network effects create this beautiful virtuous circle. The more customers you lock in, the harder it is for anyone to leave. The more users join your network, the more valuable it becomes, which in turn attracts even more users. These moats actually get stronger over time.
So how do we find the hard evidence? How do we quantify a moat instead of just telling a nice story about it? We look for relentless consistency over at least 5 years. A true wide moat company should consistently crank out high returns on equity, north of 15%, and fat net margins. But just as important, it's got to be a cash machine, converting at least 5% of its sales into free cash flow. If you see erratic numbers, that's a sign of intense competition. If you see consistency, that's proof the moat is real and working.
Okay, our forensic accountant says the profits are real. Our moat hunter confirms the business is a high-quality, durable fortress. We're done, right? Time to buy? Not so fast. We've come to the final and maybe the most critical piece of the puzzle: price. Because even the greatest company in the world can be a truly terrible investment if you overpay for it. This simple phrase just nails the core challenge of valuation. The market is not stupid. It knows which companies are great, and it usually prices them for absolute perfection. The real discipline is to not get swept up in the hype and pay a price that leaves you absolutely no room for error.
And to really understand why, we have to break down your total stock return into its two basic components. Think of them as two engines. The investment return engine is driven by the business itself, how much its earnings and cash flow actually grow. But the speculative return engine is driven purely by market mood, the change in the price to earnings multiple that other investors are willing to pay for that business.
And this chart illustrates the high multiple trap perfectly. Let's say you buy an amazing company, and its earnings grow by a fantastic 50%. That's a huge win for your investment return. But what if you bought it at a sky-high PE ratio and over time, the market's excitement just cools off? That multiple could shrink, creating a negative 60% speculative return. And the result? You owned a great business that performed well, but you actually lost 10% of your money.
So what's the antidote to all this speculation? It's discipline. A disciplined valuation process like a discounted cash flow analysis, or DCF. Instead of trying to guess what the market's mood will be next year, a DCF forces you to estimate all the future cash a business is likely to generate, and then discount that cash back to what it's worth today. This gives you a rational anchor for your buy price, and it ensures you only invest when there's a real margin of safety.
So let's bring it all home. The forensic accounting, the strategic moat analysis, and the strict valuation discipline. These aren't three separate tasks you do in isolation. They're the three legs of the same stool. And when you put them together, they form a powerful, integrated framework for building a real, lasting analytical edge.
And here it is, your three-step process. First, the inquisition. Verify the profits. Are they real? Second, the moat test. Verify the quality. Is it durable? And third, the price discipline. Verify the return. Is there a big enough margin of safety? By systematically asking and answering these three questions for any investment you're considering, you move past the simple stories and the market chatter and into the world of rigorous professional analysis. And that discipline, that is your edge.
Which leaves us with one final provocative thought. In its day-to-day, manic behavior, which of these three disciplines, verifying the cash, truly understanding the durability of a moat, or demanding a rational price, which one do you think the market ignores most often? Because the answer to that question is probably where your greatest opportunities are hiding.